Roblox, Robinhood, and Coinbase are about to collapse the IPO market. And 2021 will mark the biggest change in the IPO market in the last century, so this is big news. If you're a retail investor, this is news you really need to know. I explain why the markets are booming despite the coronavirus crisis in this video, and as a result of that, the last year has been the hottest market for IPOs in over a decade, with $331 billion being raised in over 1,500 IPOs. There's now a queue of companies in the US, including Roblox, Robinhood, and Coinbase, that were planning to have an IPO in 2021, who now are not planning to have an IPO at all, and instead are going to have something called a direct listing as a result of a major rule change by the SEC at the end of December. So what are these companies doing? What's the big change, and how does it affect you? Let's start with Roblox. The gaming company with 170 million users said in October it was planning for an IPO, and at that point thought it would be worth around $8 billion. Then in December, they postponed the IPO. Then this month, after the SEC announcement, Roblox said it had raised $520 million at a $29.5 billion valuation. And they're no longer going for an IPO, but instead, they're going for a direct listing. Imagine that. Before the rule change, they're worth $8 billion. After the rule change, they're now listing at $29.5 billion. What about Robinhood? The Robinhood app grew all the way through 2021 until it had 13 million traders, retail investors on its platform buying and selling shares. The company raised funding in September at an $11 billion valuation, and then in December appointed Goldman Sachs for its own IPO, where it was aiming to be worth $20 billion. Now, after the SEC rule change, just this week, Robinhood said it also wants to now be selling direct to investors. And now there's every chance that Robinhood also will bypass the IPO altogether for a direct listing. And Coinbase is a third company looking to do the same. While Robinhood attracted millions of small investors to start investing and trading in the stock market last year, Coinbase attracted millions of investors to invest into cryptocurrencies. This last round of funding was all the way back in 2018 when it raised $300 million at an $8 billion valuation. And then in December, it also announced it was going to have an IPO. This would make Coinbase the first US crypto exchange to go public. And now Coinbase also is saying that it may bypass the IPO process and go straight for a direct listing. So why is the IPO market going to collapse in 2021? Why is direct listings going to take over? And how does it impact you as a retail investor? Here's what happened. On the 22nd of December, just before Christmas, the SEC approved a New York Stock Exchange plan to create something which is called a primary direct floor listing. This is something which for the first time allows companies to be able to raise money from the public without having to go through the normal time frame and cost of an IPO. And it led to headlines like this. Benchmark's Bill Gurley said the change in direct listings approved by the SEC will unquestionably lead to the end of traditional IPOs. Gurley, who led investments by Benchmark and Uber and Zillow, has become increasingly critical of the traditional IPO process. But he said Tuesday's move by the SEC solidifies the direct listing as a better alternative. This is what Gurley said. I can't imagine in my mind when you can do a primary offering through a direct listing why any board or CEO would choose to go through this archaic process that has resulted in massive one-day wealth transfers straight from founders, employees, and investors to the buy side. Another headline, Silicon Valley wins as SEC allows new direct listing. Hot tech companies and other startups will soon be permitted to raise money on the New York Stock Exchange without paying big underwriting fees to Wall Street banks, a move that threatens to upend how US initial public offerings have been conducted for decades. So how does it work? Up until now, IPOs have been seen as a major milestone for fast-growing companies. This is where you get to ring the bell and see your stock publicly traded through the ticker tape. But the IPO process has been a difficult and expensive one. First of all, you have to go out and find an underwriter who's going to underwrite your shares. You need to basically put together a whole package which is going to be of interest to institutional investors. And then you have to actually set the price at the right price point without exactly knowing what it should be when it hits the market. If you're the company founders, it can be a huge amount in fees, and at the same time, if you get the price wrong, you can end up losing billions of dollars at the time of the IPO. If you're a retail investor, you're also at a disadvantage because you don't get the pre-IPO price that the institutional investors get, and you may not even get all the shares you want at the time of the IPO. So overall, it's a pretty dated system which has been around for a long time. And part of the problem is what works for the investment banks and the institutional investors is not necessarily aligned with what works for the founders and the small investors. So for example, an IPO pop is when on the first day, the IPO price goes way beyond what the price was that the institutional investors got. That's great for the investors, but it's not so good for either the founders who left money on the table or for the small investors that had to come in at the high price. An article from December, Airbnb and DoorDash's post-IPO stock pops represent an epic level of incompetency, says a former banker who led one of the world's largest IPOs ever. So this is Imran Khan, who led Alibaba's IPO back in 2014, who was talking about the IPOs at the end of last year, for example, like Airbnb, where they had a $68 price that the institutional investors came in at, and by the end of the first day, it already was up at $165. Or DoorDash, whose IPO price was at $102 and ended up opening at $182. So what alternatives did these companies have then, and now what's changed? The only two real options in the past, if you didn't want to do an IPO, is something called a reverse takeover, where effectively you're buying over a company which is already on the stock market and then doing what's called a backdoor listing. And the issue with that is it doesn't really come with the same level of prestige because you actually are coming through the back door, plus you've got all the baggage of the company you're taking over. Or the other option was a direct listing, but one in which you had to do it quietly, coming into the market without any big share offering to the public. And even though you didn't get the benefit of an IPO, even before the SEC change in rules, there were already big companies that were taking the direct listing path. So for example, Slack, Spotify, and Peter Thiel's Palantir have all taken the direct listing route. But now that it's possible to have a direct listing with all the benefits of an IPO without any of the necessary costs or challenges of pricing, we're going to see a lot more companies in 2021 choose to take this route. That means that you as a small investor are now going to have the same benefits in both timing as well as pricing as all the institutional investors out there, and they get no benefit over you. This year, the companies that were planning to have a public listing and now are very likely to go down the direct listing route, they include online grocery delivery company Instacart, Max Levchin's fintech company Affirm, dating app Bumble, AI company UiPath, and online companies Petco and Poshmark, alongside Roblox, Robinhood, and Coinbase. So this is all good news for company founders and is good news for small investors. Is it bad news for investment bankers and institutional investors? Not necessarily, as they're still making fees from those companies that are going public, and they have found an entirely new market in SPACs. SPACs are special purpose acquisition companies, also known as blank check companies, and they have taken off in 2020. In fact, 2020 was called the year of the SPAC because there was over $80 billion raised for SPACs that on average were raising over $330 million each. These are literally institutional investors piling money into investment vehicles where the only business plan is to have a plan to buy over other companies. So investment banks and institutional investors have no shortage of places where they can be going and making money. But now we're leveling the playing field. And as a result of that, expect to see many more direct listings, which will benefit everyone as well, because the barriers to entry to being a public company has also come down massively now. Also, while this will totally change the IPO market, it doesn't mean there won't still be some companies that will go down the traditional IPO route. That includes me and my company, Genius Group, where over the last 6 months, we've been working with all of our advisors, with our investment bank, towards an IPO, and we're just so far committed down that pathway, we're going to continue to go down the traditional route. I'll be sharing more about that journey in upcoming videos, so do subscribe if you haven't subscribed yet. And I'll also be sharing with you, as we're going through this year, exactly when these different IPOs will be happening and how you can get involved. Overall, I think this is great news because the finance industry is now going the same path as so many other industries where the middleman is changing, and we all are having a level playing field in order for us to get involved with the same opportunities, whatever size we are. And believe me, this is just the beginning of the disruption. What comes next? Purchasing shares in cryptocurrency, buying shares in properties in the same way that we're buying them in companies, getting involved in global investments on global exchanges. These disruptions are as much inevitable as they are exciting, because we really are shifting age from what I call the capitalization of democracy to now the democratization of capital. If you found this video interesting, please do give it a like and do put a comment below. I read all the comments and I'd love to hear what you think. And remember, the best investment you can make is in your own education, especially in such fast changing times. As William Gibson said, the future is already here. It's just not very evenly distributed.